And our stock of the day is Amazon. So counter to what we usually do, of course, you know that Amazon reports tonight, but I thought because we now have more to go on from the other hyperscalers, as they're called, that we might get a bit of an expectation, a view, because markets are really watching whether Amazon's AI-driven momentum can keep delivering. Last quarter, Amazon beat expectations on both revenue and earnings, with strength in AWS and advertising helping to drive margins higher. The company also flagged improving cost discipline across its retail business, which investors took pretty positively. So this time around, the focus is on AWS growth after signs of reacceleration, and of course, whether AI demand is translating into a meaningful revenue uplift. Can Amazon maintain margins while investing heavily in AI infrastructure? Kai Chen, MPC, we'll start with you. I mean, that's the million-dollar question, isn't it? Or we should say multi-billion-dollar question.
Exactly, or potential trillion. Yeah, no, absolutely. I think, Amazon, in terms of AWS, is definitely the biggest cloud provider in that space. And, you know, the question as to whether they've actually delivered to expectation or not, you just have to look at the Q1 results, right? So beat by about 70% against the consensus. So their EPS came in about 2.78 versus 1.63. So they are making a lot of money, right? So there's no question as opposed to whether the uptake is there. I think really what everyone's really looking at is the Capex expenditure and whether, you know, relative to what they're earning, are they making too much of a big bet? And in reality, I don't think so, because, you know, there's a huge backlog that exists for AWS, right? So there's about 364 billion backlog just in Q1. So, you know, that Capex is there for a reason. They have to build the capacity. Like, just imagine if you had all this uptake in demand and you had not enough compute and infrastructure to cater for that, you know, you're going to lose in that race. And infrastructure is not quick to build. It takes, you know, years to build that capacity out, and they're doing the right thing. You know, the converse argument would be like, say, let's take another example like Oracle. You know, for what they're earning, they've made a extremely big bet in terms of Capex against that. So, you know, if there's any fluctuations, Oracle might be the one that gets punished for it. But AWS, you know, it's an aggressive bet, but it's not outsized relative to what they're earning.
So what do you think of Amazon's price at these levels?
Yeah, I think it's going to consolidate, as with the whole tech sector in general. So it's not immune to the market fluctuations. But yeah, the hyperscalers in the medium term are definitely good bets.
So it's a hold?
Yep.
So Amazon, how does Amazon fare if we do see a whole bunch of uptake of cheaper Chinese AI?
It doesn't make a difference. It makes no difference to them, because what they're selling is the compute to process the models. So whether you're running a Chinese model or you're running a Claude or whatever, it makes no difference to Amazon. So at the moment, the whole thing's going to change anyway, because what's happening is there's significant pushback on the model companies, so the OpenAI and Anthropic, because they're actually seeing everybody's data, and then they're now actively trying to get into commercializing stuff in themselves, which means they're a threat, and everyone's worried about their data being seen. So part of the argument with open source models is you can run them on your own servers and so on, but there's a bigger play here, and that is the whole orchestration and the harnesses of how companies deal with running their AI. And I think Amazon, Google, and all the hyperscalers are all in a fantastic position to be able to make a lot more money out of it and shift all of that earning that's currently going to Anthropic and OpenAI. I think it's going to go to them. And the reason is they control the compute. If companies don't trust the models, which they don't, that's becoming more and more apparent. Jensen Huang just did an open letter on X arguing why the government shouldn't do anything about open source and let it all run, because we need the competition and the fact that the industry doesn't trust the closed models at the moment. So I think there's a massive trend, and 70 companies, major companies, have all signed on supporting that, apart from Apple and a couple others, but OpenAI did, they signed it as well. Anyway, point I'm making is, if I'm a big client and I'm spending $100 million a year on Amazon at the moment through OpenAI, there's no reason why I can't spend that directly with Amazon, and then Amazon then route the jobs to whatever the most efficient use is, whether it's an open source, their own closed system, or premium Fable 5 or whatever. And then they run that, and they then make the margins that would be being paid for by OpenAI.
Okay, so it becomes part of the infrastructure.
I think it's a major change. I think it's a really big deal, and I think it's all the hyperscalers are in a very, very strong position to be able to capitalise, as is NVIDIA. Jensen Huang has done deals with Palantir and Lang Chain, which are specifically for what I'm talking about. So it's about getting better value for the user, but it's where does the value accrue? That's the point. And I think a lot of this value isn't accruing at the hyperscalers. They're renting the compute at the moment to OpenAI, and OpenAI is making the lion's share of the profit. I think that'll switch. I'm quite bullish on all of them actually, but
Okay.
so it's a hold at the moment. We haven't done any work on Amazon yet. We are about to, so I don't have an opinion on whether it's a buy or not. But I'd say it's a hold.
Got it. Thank you.
So
All right.
long-winded, but it's a
Well,
big
that's
issue.
okay.
at the
Some
moment.
of it I got to admit, and I'm sure I speak for some out there, went a little bit over my head, but we'll get there, won't we?